Hi there, Evan here with Crypto and Markets for Friday, January 18th, 2019. I'm going to do a quick audio only here, talking about quantitative easing and give to you guys and gals a then and now. First, let's look at it from a stock perspective or a market's perspective. Tavi Costa from Crescat Capital, who, by the way, it came out this morning, is actually shorting the Canadian banks, but I digress, put out a chart a couple of days ago talking about the percentage of publicly traded companies that have negative cash flow. Now, two things I want to mention on this point. Zero Hedge put out an article the other day stating that global M1 money supply already states we're in a recession. I agree with that article and the premise of it and what was stated within it. I will link it down below. But within the article, there actually was a chart talking about, for the first time in almost a decade, central banks around the world are net tightening. What does that mean? Instead of putting liquidity into the system, they're pulling liquidity out of the system. And it can make a great argument as well. That was one of the main reasons, if not the main reason, for the fourth quarter sell-off that we had in the stock market. And the commodity markets as well, too. Central banks pulling back what really was the number one drug for markets remaining elevated here as far as valuations goes for as long as they were. Because remember, this was the slowest of any recovery on record. And if you follow the work of David Rosenberg, you'll know there's a massive bubble right now in triple B corporate rated debt. Triple B rated corporate debt, which is the rating right above junk. So two points I wanted to make on that. One, if it wasn't for quantitative easing, a lot of companies wouldn't be around today. Now again, won't mention individual names on here. We're just focusing on the macro. But it's fair to say a lot of companies wouldn't be around today. And secondly, quantitative easing just kept forcing money back into the markets. Hence, we have valuations now that are about as expensive as they've ever been in history. Corporate debt fueled capex. Corporate debt fueled buybacks. Hence, slowest recovery on record, very little revenue growth, buy back a whole bunch of stock, can artificially go ahead and fix that. I saw a chart a few months ago. I should probably go ahead and link that down below for you if I can go ahead and find it. Margin debt to GDP. In October, right before the sell-off, it was over 3% of U.S. GDP. But that's just it. It's over 3% of U.S. GDP. The stock market in and of itself was 150% of GDP. And remember this. After the U.S. housing bubble, home ownership rates in the U.S. were steadily going down until about 2014. They're up a little bit since, but that kind of proves the point. For many people, the stock market was the economy. Now, of course, in other countries, Canada and Australia namely, quantitative easing helped fuel massive real estate bubbles in Canada, in Australia. You can even look to the U.S. coast as well, the UK. We can go on. Now, to focus on that, as I mentioned a few times on this channel, there was the big quantitative easing push that was done 2014, 2015, and early 2016, which, ironically enough, was when China had their first slowdown. It was also the same time, because of that, there was outflows coming out of China into global real estate markets. And if people don't think China had a big play in the global growth narrative, as I've said many times, just plot the Chinese credit impulse against global manufacturing. Plot the Chinese credit impulse into global inflation expectations. Plot the Chinese credit impulse into the cyclicals versus defensives indicator in the stock market. China really helped drive a lot of things. Now, of course, as we know, the deleveraging that's going on in China right now, a lot of it is self-inflicted by the regime there. But even then, how many countries in the world, I mean, forget even real estate for a second, how many countries in the world is China either the number one or number two trading partner? But I digress. Going back to the stock side, going back to the real estate side, 2014, 2015, early 2016. The big coordinated global quantitative easing push. Now, the U.S. at this time was done their quantitative easing, but still rates were at zero, and monetary policy, because of that, was still very accommodative. But the Reserve Bank of Australia cut rates. The Bank of Canada cut rates. Caused FOMO in the various real estate markets. Capital outflows from China were going into these real estate markets. Hence, you had that big blow-off top in credit, which led to the late-stage crescendoing effect in both, along with many other real estate bubbles. So really, quantitative easing forced an addiction to shorts. More money, just kept piling onto more money, and things seemed so easy, it just kept sucking us back in. That's really the best way to put it. And now, of course, the M1 money supply globally, at least the growth in it, peaked Q2 or Q3 2017, and the growth rate's been going down ever since. Then, of course, every central bank in the world, late cycle, decides now's the time to put on a hawkish stance. And it looks like now they've taken us off that addiction, off that constant flow of money, And now we see in the overall economy how little was there to begin with. As far as what happens here, again, stock market went into a bear market. It bottomed out Christmas Eve. You've had a massive bear market rally back ever since. I think in due time here, we're going to go right back down. The credit cycle has turned globally, and all the offshoots of it, home improvement, cars, furniture, appliances, they've all turned down. Another leading indicator, transportation, that's turned down as well. And even look at the stock market bounce itself. It's really telling you that. The stocks that really haven't bounced are ones that you want bouncing, let's just say, if the economy really was better. So to put it in closing, it was too good to be true for too long. And globally, we're just starting now to figure it out. All I gotta say, hit that like button, leave a comment down below, subscribe for more, and most importantly, follow me on Twitter, @CryptoMarkets2. You'll have a good night.